Let's go. Good morning. Welcome to the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. Today is Tuesday, the 20th of December. Santa Claus is getting ready, folks. I'm JD Durkin. Opening bell rung here on the floor just moments ago by Amplify ETFs. Let's take a look at how the major averages are kicking off this Tuesday. They have been trading down fractionally in the last minute or so. This after Wall Street was hit with yet another down day, with all the three major averages notching their fourth consecutive day of losses in yesterday's session. Investors a bit concerned that the market will not be able to pull off an end-of-the-year rally or a Santa Claus rally as recession fears continue to mount. Let's take a look for what's on tap for this morning's broadcast. We will talk overall market sentiment, of course, as recession fears loom large. Plus, Amazon settling a massive probe with the European Union. We'll tell you how this will impact your shopping experience. And finally, we'll be breaking down what is going on with Apple as it gears up for a pretty rough holiday season. Everyone wants those new iPhones. Might be a little bit more difficult than you already thought. And even that was already going to be a little more difficult than it was supposed to be a few months ago. For more on those stories and so much more, we now welcome in our senior editor, our chief markets correspondent, Mr. Martin Baccardax. Martin, good morning to you here, my friend. Before we get into like the broad brush, actually, I'm going to let you choose. Choose your own adventure. You want to do big picture markets to start, or do you want to jump right in on the Bank of Japan? Because that is certainly a big overnight story. I'm going to let you choose on those two.
Yeah, I think Bank of Japan, JD, is probably the way to go because it's had such an impact on Treasury bond yields, and that seems to be what's holding down markets this morning. Essentially, overnight, the Bank of Japan wrapped up its December policy meeting. They didn't make any changes to their zero interest rate scheme, and it's been that way for a number of decades now. But what they've decided to do was expand the range in which they will allow government bond yields to trade. Sounds a bit pointy-headed, but essentially what they've tried to do over a number of years, JD, is keep bond yields basically at zero in the government bond space in order to entice investors out of that safe market and into the broader economy. The hope is that they can reduce returns on JGBs, Japanese government bonds, to such a degree that they move people out of that space and they make investments into the real economy, which will create growth, create employment, and stoke what has been a moribund economy for a number of years now, and it's the third largest in the world. So they expanded the rate in which bonds will be allowed to trade by 25 basis points. It doesn't sound like much, but it's the first step possibly to the Bank of Japan actually lifting its benchmark rate. That probably won't happen until 2023. If it does indeed at all, there'll be a new Bank of Japan governor in the spring. He could end up being a bit more hawkish than the current head. We'll have to see. But I do think that Bank of Japan story was the most significant. The yen basically jumped about 3 to 3.5% against the US dollar overnight as a result of that change. Japanese government bonds traded at the highest levels in 2 decades, and that's just a major, major move in one overnight session. It bumped up U.S. Treasury bond yields quite significantly, and we're seeing ripple effects through the market altogether. Nikkei closed at a 3-month low as well as a result of the change. So significant for sure, and it's having implications for our market too.
How should domestic investors who very closely follow the news of the Fed that we cover here every morning seek to compare the actions of a Bank of Japan versus what's happening here?
Well, I think it's indicative of central banks coming into line. Bank of Japan was kind of the outlier with respect to its inflation stance. Inflation in Japan has been muted for at least 3 decades, really for as long as I've been paying attention. And there's a whole host of reasons for that, but it's tested the whole theory about inflation being a monetary phenomenon because Japan actually embarked on quantitative easing in the late 1990s, and it hasn't really had a significant impact on inflation until now. Japanese inflation rates are very low. They're only about 2%, but this is the first time in a number of decades that they've even come close to that target. So it does suggest that the Bank of Japan could begin to alter its policy stance with actual rate increases. If that is indeed the case, that's going to put further downward pressure on the US dollar, a good thing for US companies, not the greatest thing for import prices in the United States, which could add to further inflationary pressures here in the United States. So there is the possibility for that. And I think the most significant on top of all of it, JD, is Japan is the world's largest holder of US Treasury bonds. They are the biggest, basically, creditor to the United States. If it turns out that higher Japanese government bond yields give their citizens an alternative to investing in treasuries to fund their retirement, and it's one of the oldest populations on earth, that could have carry-on implications for US borrowing costs going forward. It won't be significant and it won't be titanic, but at the margins, it will be increased. And that, of course, has implications for tax and spending policies here in the United States, and indeed the overall shape of the US yield curve.
And was this pretty much an overnight surprise? I feel as if it's been a while since we've gotten real big headlines that are being driven specifically by the Bank of Japan, but give me your read as to how expected a move like this was.
There have been whispers of a potential change, but this was significant, particularly when you talk about the size of the expansion of the trading band. And I think simply because it does seem to be the precursor of a change in broader interest rate policy, it was also seen as a significant movement as well. I really think that the yen which of course has been exceedingly weak for a number of years now. Indeed, this year, I think it was a 31-year low against the US dollar as a result of a whole host of sort of complications with regards to import prices in Japan, et cetera. But yes, this was a notable surprise, particularly on the size of the band and the expansion of the trading range. And again, seems to be indicative of what could be a really big policy change in a country and for a central bank that has been playing the same game for over a couple of decades now.
Outside of the BOJ, what are some of the other top factors they are weighing in on domestic markets into today's session, you think? What else is top of mind?
Well, I think we had another indication of economic weakness through housing starts data this morning. Both housing starts and building permits were weaker than anticipated, and we sort of knew that was going to happen. But it came on the heels of a home builder sentiment survey yesterday, which showed 12 consecutive months of declines, and that's the most on record going back to the early 1980s. So the housing market is rolling over and continues to do so. Has been a slight pullback in mortgage yields, in mortgage costs since their October peaks, but nothing of any great significance. And with the Fed continuing to raise, I'll be interested to see how far and how long that lasts. We'll get fresh mortgage data tomorrow as well from the Bankers Association. But I think that the housing data, as well as the broader economic weakness, is now sort of overtaking the inflation story to some degree with regards to U.S. market performance. And that's why I'm just checking it now. We're a little bit higher on the Dow, but we still could struggle today. And if we do end up in the red, that's going to be 5 consecutive session losses, and certainly makes that Santa Claus rally more difficult to execute.
If anyone's been hearing these headlines with regards to things like housing starts and mortgages, and they say, I want to become better versed in this, I want to become a little bit smarter in this, in terms of being able to follow where this story may go in 2023, what would you advise that investor to look into to become a little bit better about this? Are there other key pieces of data that you follow or guidance that you would recommend if people really need to begin to wrap their head around this? Because it is becoming much more of a story that may not have been on their radars necessarily, on top of all the other economic news that we cover breathlessly day to day.
Well, that's a good question, JD. Housing starts are obviously an important and leading economic indicator, and I don't want to downplay them at all. But it is worth noting that this is a services-led economy. About 2/3 of economic growth drivers are linked in some way to the services or the consumer sector. So understanding the nature of consumer spending in the employment market, that tends to give you a much better understanding of economic conditions than in the manufacturing and the housing space. So to that, in that respect, there are 2 important components that are worth looking at. One is called the ISM, and the other is PMI. The ISM is the Institute for Supply Management. They run a monthly survey which looks at, basically asks managers of the biggest companies around the country various questions about their order books, about their hiring costs, about their hiring practices, economic activity, and the rest of it, and pulls it together into a single number. Now, that number, if it is over 50, generally indicates economic expansion. If it's under 50, it indicates contraction. The same is also said for the PMI, Purchasing Managers Index data. Again, similar questions, similar construct, and the numbers are the same. Over 50, expansion; under 50, contraction. Those numbers come out every month, and they're excellent precursors to what we're seeing in terms of economic growth. And they're both at this stage. Well, actually, that's not true. The ISM is a little bit firmer than the PMI. But the PMI numbers do suggest ongoing weakness in economic activity. It hasn't been played out in GDP data just yet, but certainly the indications are. And I think I saw a poll this morning saying 7 out of 10 economists are predicting a first half recession in 2023. It will certainly play out relatively soon.
Yes, absolutely. Actually, let me ask you about recession real quick in terms of recession definition, because obviously you've got the more traditional, so to speak, definition, 2 consecutive quarters of declined GDP, but then you've got the dating committee of the NBER that actually retroactively looks at data from about a year before and says, okay, yes, actually we did hit a recession, but we didn't know it till now. Are there one of those two that you personally subscribe to over the other? I feel like the official definition, we usually wait for this group of economists and university professors, but I don't know if I've ever asked you directly, is there one over the other that you tend to put more weight in?
Yeah, I mean, I can understand why people would want to shy away from the 2 consecutive quarters of negative GDP, because it is a little bit of a rough estimate. It's a back of the envelope calculation, obviously. But what it does do, at least in the popular consciousness, is reflect the way that people are experiencing an economic decline. So even if it's not technically a recession, and the technical definition is more about a sustained decline in economic activity over a long period of time. It doesn't typically give a time frame. It talks about a long period of decline and a sustained time frame. Even if we don't hit that technical definition, when you do get those 2 consecutive quarters, most people understand it to be recession and will alter their behavior as a result. So the academic in me probably points to the official definition of recession, which comes much later. But as someone who pays attention to financial markets each day and economic activity in that respect, I will confess, I do reflex to the standard definition of 2 consecutive quarters of negative GDP.
All right, absolutely. And then thank you for letting me ask that, because if you look back at the 07, 08, 09 downturn, the official designation, so to speak, wasn't for a full year later, right? I think it was December of 2008 when the dating committee said, okay, we actually did hit a recession in December of 2007. And then in terms of being defined as out of the recession, it was well more than a year. It was something like September 2008, but they didn't actually define it as such until very late of 2010. So, it's the sort of thing you may hear headlines of later on this year. I wouldn't be surprised if at some point in 2023, the group comes out and says, yes, we've actually been in a recession now, for quite some time, or several months. Anyway, that's how we've seen it. So thank you for letting me ask that. I do want to also ask you about earnings later today. We touched on it yesterday. Talk to me what's top of mind for you and the main data points investors should be closely paying attention to, as we are reminded once again that earnings are upon us, and some good names too.
Yeah, we've got some big names coming up after the bell, Nike and FedEx being the most important. But what's interesting to me is an earnings forecast going into not only the fourth quarter season, which basically kicks into gear in the early part of January, but heading into 2023 as well. Morgan Stanley published a note yesterday where it talked about the potential for S&P 500 earnings of around $180 per share. That's about a third behind the current Wall Street consensus of $231 a share, and that's a significant gap. And they say that if we do move in that direction, that will probably elicit a 20% drawdown for the S&P 500, taking it closer to 3,000 points by the end of next year. I really do believe that the Fed would be mindful of its sort of inflation fighting stance at that stage if we were to see a sustained pullback in stock prices, even if they often tell us that that's something that doesn't factor into the decision making. So I would be surprised if that was what ended up materializing. But nonetheless, I really do think that we're going to see some weaker projections, starting with the banks and going into the tech space. And as a result, I think we're going to see earnings pressures, uh, compressed profit margins, and as a result, underperformance for U.S. stock.
And what are expectations here in terms of what CEOs and other leaders from these companies on earnings calls will say about entering a recessionary environment? Is it the sort of thing they stay away from, or are they really trying to make sure their investors are well prepared for what could very well be a bumpy road ahead?
Yeah, I think cost, JD, is probably going to be the focus because I think you're absolutely right. They generally try to avoid recession talk, or at the very least, hand over any recession forecast to the economists and essentially focus on what they can control. So, cost cuts, I think, and either hiring freezes or layoffs are going to be a significant portion of those look ahead forecasts. The demand equation is largely going to take care of itself, and it can't really be stoked in any significant way. So again, it's going to come back to the things that CEOs can control. And so I see that as being an enormous factor in the earnings projections. The US dollar strength won't be as significant a headwind as it was in 2022, and that's certainly going to be a relief. Input costs are starting to peel back just a little bit. And as a result, that's going to allow for at least some support in terms of profit margins. But again, those cost cuts, I think, and cost controls are going to be the most significant of the conversations that we have from CEOs in their conference calls after the earnings.
All right, I do want to ask you about Amazon. We've talked an awful lot about the EU this week with regards to its continuing crackdown on, either broader antitrust concerns. But we were talking about one company yesterday, and now we've got Amazon in the headlines as well. That company settling a battle with the EU to avoid antitrust fines. What do we know there, Martin?
Yeah, three different sort of components of the antitrust battle that they've had with the EU, mostly with regards to how competitor items are displayed on the Amazon website when it comes to purchase time. There's something called the buy box, which is that sort of like white rectangular space to the right of the page when you go to buy, let's say, headphones or something like that. Inside that box is add-on purchases and other things which are incredibly lucrative to vendors because they already have somebody who's engaged in a purchase, so the likelihood of them buying more is increased. Now, the EU has said that Amazon prioritizes its own products in that buy box, and as a result, it engages in anti-competitive behavior. So Amazon is going to allow more prominent displays from different vendors, from rival vendors, in that buy box in order to try to placate some of those concerns. And another aspect, I think, which is really important in this, JD, is that they are going to let vendors inside the Amazon marketplace choose their own logistics firms instead of having it chosen by Amazon itself, freeing them up to maybe cut their costs a little bit as well. But again, indicative of the fact that the EU Commission has had American tech companies in the crosshairs for a number of years now. They've been at the forefront of regulation in terms of keeping in check some of those anti-competitive practices, and they wield significant influence. They can fine companies as much as 10% of their global revenues. In the case of Amazon, that would be an absolutely enormous amount. So they certainly were motivated to come to a settlement with the EU as far as that's concerned. And probably even more so, JD, when you consider the fact that the stock has now given back all of its pandemic gains and is down a bit more than 50% for the year. They've talked about demand weakness going into the quarter and indeed beyond. Their cost situation is also incredibly complex, given the increasing wages that they need to pay to entice people into the warehouses and other components of the business. So I think that was probably at least a factor in coming to this agreement with the EU and trying to neutralize that overhang. It's the last thing they need now heading into a very difficult year.
And we talked about Meta yesterday. Shares of that company down 66% year to date. We talked how the company could face more than 11 billion US dollars in fines as the EU charges that company with breaching antitrust rules. It always seems like the biggest antitrust, and understandably so, but the companies we tend to focus on largely are these two. Amazon with regards to its marketplace or its e-commerce marketplace, and then now Meta with its marketplace. I wonder, are there other names that maybe you have followed that are similarly under the microscope or in the crosshairs of the EU that maybe don't get as much attention or headline-grabbing focus as a Meta or an Amazon?
Yeah, Google is at the moment in the process of appealing at least one and possibly two EU antitrust fines with respect to sort of, yeah, again, allegations of anti-competitive behavior in search and abusing its market dominance there. So it's certainly not only limited to Meta and Amazon, but again, just sort of illustrates the reach that the EU has and the influence it has over the major US tech companies. Now, there are those who would say that reach is potentially and possibly disproportionate and is reflective of the fact that European tech companies haven't had the same levels of innovation as their American counterparts. And as a result, European lawmakers have had to use these sort of the competition commission as a way to rebalance the difference. In other words, if European companies had been as innovative as they should be, the Commission wouldn't be as minded to go after US companies in the first place. I don't know how convincing that argument is, but I can understand where people would derive it from. I think ultimately, European tech companies have been innovative, but just in different spaces. We've, of course, had significant success in the chip makers in Germany and elsewhere, and certainly with respect to Spotify in Sweden and a couple of other companies. There has been some good success stories in European tech, but certainly not to the degree that we've seen in the United States.
Now to another company that is trading down now about 28% year to date. It's Apple. That sounds terrible for longtime Apple bulls, but perhaps everything is relative. And you compare that 28% downward figure with any of these other names we just mentioned, Apple's been faring proportionally better, I would argue, year to date. But regardless, though, JP Morgan slashing Apple's price target while issuing a muted holiday sales outlook. Why a bit of bearishness on the stock here? What is the company going through the last day?
For the most part, JP Morgan is looking at the implications of the supply chain disruptions in China, particularly as they sort of link through to the key manufacturing hub in the northeast city of Zhengzhou. We've, of course, talked about that on a number of occasions, how workers there had been protesting against conditions and pay and COVID restrictions and all the rest of it. And as a result, Apple itself warned that some of its high-end phones would be limited in terms of availability over the holiday season because of those disruptions. So JP Morgan basically put some more numbers on it this morning, saying that iPhone supplies over the December period would probably be hit by about 4 million units, taking it down to 70 million. They had already cut it by about 8 million in the month of November as well. So that's certainly going to have an implication for sales because iPhone sales, of course, drive the bulk of Apple revenues. The price cut wasn't enormous, but it was significant enough. They took it down from $200 a share to $190. What they did say, JD, however, was the demand equation in the Apple story is still so robust that even if there was a delay in providing some of these iPhones into the December quarter, it would get picked up again in the March quarter, which again is just indicative of how powerful a brand Apple is and how loyal its customers are.
Of course, that company is still facing supply constraints due to China overall. Is there a future where Apple has nothing to do with China, or simply, as we've seen the last few months, just headlines with regards to decreasing its reliance on China?
It's not a future that we could see anytime soon, and maybe it's not even possible at all. I think it's, no, let me say, I think it's possible, but I don't think it's probable. I think there could be a scenario in which Apple were able to wean itself off of China reliance and maybe diversify some of its supply chain and manufacturing operations outside of China and into different parts of South Asia or even possibly here in the United States. But that would have an enormous impact on overall pricing. And that's something that I think Apple is just not comfortable doing just yet, even if they wanted to. And of course, the time frame it would require to take out all of these supply chain, particularly the manufacturing space in China, and disperse it elsewhere is significant indeed. So yes, I think it is a possibility. But again, it comes with such a cost that I just don't know that Apple would want to embark on that sort of journey at this point. I think they're probably better off managing the disruptions and the vagaries of supply chain in China, which have really only been problematic since the pandemic. Now, that, of course, is still a long time. We're approaching the 3-year anniversary. But I don't think they would be in a situation just yet where they'd want to pull the rug up from all of it. What they would like to do, I think, is just have a bit more diversification. And they are trying to do that with manufacturing hubs in Vietnam, in India, and this new chip venture that we have been speaking about in Arizona.
Yes, absolutely. That's right. As we talked about yesterday, we had Tim Cook out there with President Biden and the leaders of, who else was there? Micron, NVIDIA. It was quite the event. I mean, for Tim Cook to get up there and talk as long as he did, obviously it's a top priority. Anything else here on Apple before we pivot here to? Oh, actually, I do want to ask you. You wrote a note about the March quarter, about what it could look like. Can you expand on that quickly before we head over to rapid fire? What might, a few months into 2023 look like for Apple?
Well, that quarter is typically the weakest for Apple. So I do wonder exactly how that demand will be picked up. But again, we are sort of in a period of uncertainty that it doesn't really have a great deal of precedent. So if we are looking at disruptions that filter through into December availability, and it probably will get picked up in March, and as a result, that quarter could be a little bit stronger. It's always amazed me, JT, at how people are willing to line up for these new handsets, even when there's only incremental difference between the newer and the previous versions. And that's been the case for a number of years now. Of course, it speaks to the ecosystem and the fact that most people are, I don't want to say trapped, but their online lives are within that Apple services system that basically makes very little sense to try and exit it into an Android phone or something else. So that could at least provide some clues as to why people are not suffering from upgrade fatigue just yet. So I see the potential for the March quarter being a little bit better than anticipated, but again, it's probably the weakest of the four in any given year as a result of the Christmas hangover.
Yeah, and as we were talking, you mentioned Vietnam. A new Nikkei Asia report just out today says Apple will begin producing some of its MacBook computers in Vietnam in 2023. Something you had just mentioned, India and Vietnam, and quite literally as we're talking, there's new updates about that. Another part of the Apple story, we don't have to get into it now, but it's going to be really interesting to see what happens is with continued pressure on the 30% fee, the App Store. Will Apple be compelled to build some kind of workaround? Of course, Apple's big, long-standing argument is to say we can keep our products and consumers as safe as we can because there is no workaround, essentially, right? Because we are a one-stop shop, we have control over the means by which people get this information. If you force us or compel us to build a new way for people to get apps outside the App Store, we no longer have that control. Bad actors could get on. That's a really fascinating debate that is going to impact all of us who have Apple devices and how we get the apps onto our phones. That might be it's going to be an interesting storyline to follow for the next year, especially as maybe Congress gets more involved. We'll see what Republicans, I also don't know what Republicans necessarily have up their sleeve in terms of tech regulation, what they're really going to pursue. TikTok's obviously top of mind for many, but that's going to be an interesting story. Okay, time now for our rapid fire section, if you're game for it. First up, let's talk GM. Eating your Wheaties here, Martin. We'll lead to General Mills' strong Q2 numbers. The other GM.
Yeah. Very solid, actually. They beat on the top and bottom line, adjusted earnings of $1.10 per share, and then a 4% gain in revenues, which I think came in around $5.2 billion. But again, this is a story, much like some other companies in the home food staples sector that have been all about pricing power. General Mills makes Cheerios, a bunch of other brand name cereals, has been able to pass on price increases to its customers, irrespective of their fighting inflation on a whole bunch of other fronts. When it comes to these staples food items, people are prepared to pay the higher prices. So General Mills has been successful in that. They boosted their full year guidance for sales growth between 8 and 9%, and for profit growth between 4 and 6% on an adjusted basis. They did hint to increased input costs heading into the back half of the year. I don't know if that's exactly the reason why the stock was weaker, the last I checked going into the start of trading. I wouldn't imagine it would have that significant effect. This might simply be a case of sell the fact. The stock is about up 24% so far this year, definitely one of the outperformers on the S&P 500. You get the better earnings and you get the robust forecast, and it's time to take some profits. So that's not terribly surprising. But good numbers from General Mills, and again, companies that have pricing power are the ones that have performed best over most of this year.
All right, on to number 2. We talked to earnings earlier on in the show, but let's do a little bit more of a deep dive into FedEx. Will that company deliver its Q2 figures?
This is all about cost cuts, JD, as we spoke about. FedEx has talked about the fact that they have a $2.7 billion cost reduction program in place over the coming years. Around 700 of that is going to be reflected in the November quarter. So they're all about execution at this point, given the fact that we're seeing macro headwinds, which are probably going to keep revenues in check. They're going to be largely flat compared to last year. And therefore, of course, the focus is going to be on costs and margins. Now, FedEx is expected to post a bottom line of $2.83 per share. Revenues $23.75 billion, again, largely flat to last year. But certainly what this company says about demand going into the start of the calendar 2023 year is exceedingly important. And what they plan from the cost-cutting perspective is also going to be paramount for investors because it has such implications for profit margins. They furloughed some employees in their express division. They've grounded some planes as a result. There just not being enough demand to justify the expense. And they're going to be putting more of these cost-cutting measures going forward. So we'll keep an eye on that. But certainly any commentary that they have about macro headwinds into 2023 will be keenly watched by investors. We'll get those numbers after the bell.
And we'll keep the conversation going about numbers after the bell. How will inventory, third and finally here, inventory pressure, there we go, affect or impact Nike's quarter as well?
That's going to be the big story for Nike. They basically had a massive accumulation in inventory over their August quarter. It got up to about $9.7 billion in terms of overall supply, and they're going to have to shift that with discounts and cost cutting in order to try to get back to a more sort of manageable level. So profit margins are going to be absolutely in focus as a result of that. And of course, what they're saying about China and demand there is exceedingly important because that's one of the fastest growing markets. They're locked head to head in a battle for market share there with Adidas. And as a result, don't want to give up any ground. But of course, the COVID pandemic there has impacted consumer spending significantly. So those are probably going to be the two most important components to the earnings discussion. Analysts are looking for, I think it's 65 cents a share on revenues of about $12.6 billion. But yes, inventory, discounts, and what they're doing in online sales will probably be the most important things we'll get out of the earnings today.
Martin Baccardax, the great Martin Baccardax. If I'm not mistaken, my friend, this is our last show of the year. Is this our last show of the year with you? This is our last show of the year with you.
I think it is. I'm sad to go out on a bit of a flat note, but I've been suffering this flu now for about 2 or 3 days. And I'm just feeling a little bit, So I think we'll bring the pain when we come back in January. See, I can't.
We'll bring the listen. If you want to take an extended break through June, which I'm assuming there's a lot of travel for both of us between now and June, that would be fine. But I think January is long enough. But listen, you need to rest up, my friend, because listen. Your Dolphins, you're gonna have some playoff football, Martin, and you're gonna want to be primed and ready to go to watch your Fins in the playoffs. I'm holding out hope for you in the AFC. And we got a lot of good sports and stuff. If wishing made it so, well, we'll see what happens. Martin, my sincere thanks to you, and I send you and your best, you and your family, rather, the absolute best for an amazing holiday season. A very happy New Year. Thank you for everything you've done to help us all get smarter together, and look forward to hitting the pavement with you, man, and doing this all again after we reach 2023. Martin, thanks for everything.
Thanks, JD, and to you as well.
Enjoy your very well-deserved break, Martin. We'll do it again soon. All right, folks, and that is going to do it for the Market Open here from the floor of the NYSE. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you soon enough.